IBTC, like I said, we're really in celebration mood, but coming to the fixed income space, trading activities in the bond market last week was relatively flat, though there was a sell down targeted at specific instruments following the release of the February bond auction circular. Meanwhile, the Debt Management Office plans to offer 105 billion naira in the reopened April 2017, June 2019, and January 2022 bonds at the February auction on the 13th of February. And to give us more on the bond market and, of course, the mood on his trading floor is Sam Ocheho, is head of global market trading at Stanbic IBTC. Of course, covered in Nigerian green and white. Sam, fantastic victory last night. And of course, I know that you're really a soccer buff. I remember we did play a tournament together at some point. I think it was a bankers tournament. So let me ask you, how did you celebrate the victory yesterday?
Well, I guess I ran into the streets celebrating. We all went gaga yesterday, I must confess. And I'd like to say big congratulations to all Nigerians. I think the Super Eagles made us proud, and we're still in a happy mood. We're still celebrating, and I hope the market celebrates with us this week. And
I know that there is a reception by the presidency tomorrow, and in the old days, one would say it's definitely going to be a public holiday, but we'll see how that plays out. Hopefully, there'll be an announcement, possibly along those lines from the presidency, but I don't know, maybe with democracy things have changed. But let's move on to the markets. Sam, like I mentioned, the bond auction coming up. But maybe we should start with your thoughts on the appetite of foreign investors for Nigerian bonds these days. We know yields have come down significantly, but at the same time, we've also seen the Naira very strong, very relatively robust over the last few weeks. In fact, this year, considering where the external reserves are at $46 billion and where the oil price is well over $100 per barrel, everyone will say we're in a good place with the currencies. But your thoughts on the appetite of foreign investors for our bonds these days?
Okay, well, since the inclusion of Nigeria in the JP Morgan Index, we've seen a lot of offshore interest in Nigeria. Nigeria has opened up to the world again, and that has caused yields to rally from where it was up to the current levels of around 1080, 1090. This is we're beginning to see some slowdown from an offshore appetite, in the sense that the current level seems not to be as attractive as it used to be. So what we're seeing is a movement from bonds into T-bills, which still offer attractive yield and short duration compared to where the yields on the bonds are. So if you ask me, the flows we see mostly these days are into into T-bills and equities as opposed to bonds. There's actually slowdown. And the rallies we've seen in recent time has been occasioned by locals. There's been much liquidity in the system, from maturing bonds to OMO liquidity. In this first quarter, we've seen a lot of liquidity, and I think that has been chasing the bond as an asset class from the local appetite. So the drivers in the last few weeks are more of locals than offshore.
Okay, and bond T-bill yields are somewhere around 11% right now. How much lower do you think they could go? And at what point do you think we may see a shift of investor appetite, particularly from the foreign investors in that space?
Well, the truth is that as long as T-bills is an asset class, and as long as there's liquidity in the system, it will keep chasing this asset class, because the question is, where else would they be invested? Yeah. And if I want to answer the question around what would make the offshore not to come to Nigeria, first of all, the things the offshore will look at is the stability of the currency and also where the yields are offering at the moment. Among the countries in the JP Morgan Index, Nigeria at this level still offer the highest yield. So is our country, is the currency going to be stable? If the outlook on the currency is that of stability, then you still expect to see more offshore flow, because it still offers them the highest yield. But again, there are a lot of concerns over the currency. People are not sure of it on the long term. And the question is, what will happen if there's most of the risk that we see to the currency are actually exogenous factors, such like an emerging market crisis, with all the issue of fracking in the United States, what happens to oil prices, and then there's also the question of Sanusi himself. 2014 is going to be up for re-election or re-nomination in 2014. I don't think the question is, Would they re-elect him? Would they renominate him for the position? If it is not, who is going to come in? What monetary policy outlook is the person going to have? So these guys, they are beginning to look at all this, and some of them, instead of going long duration, they are beginning to stay short duration, so that in case there's any emerging market crisis or there's any problem, the impact on their books will not be as much as staying in long duration.
But let me ask you, in the short term, of course, we still have to play this market. There's, of course, a lot of uncertainty going forward. But in the short term, how do you think the yields are likely to play out, particularly for the bonds? We have an auction this week. What are your expectations?
Well, I think the auction this week is going to come out with yields ranging from 10.6 to 10.95 across the curve that is being auctioned. I don't see any major divergence from where current market levels are. So even if the offshore guys decide to participate, I don't think we're going to see a major crash in yield. It is expected to remain at this level.